All right, let's talk about something that sounds incredibly complex: oil and gas accounting in Malaysia. You've got these massive, multi-billion-dollar assets, a ton of intricate rules, but you know what? We're going to break it down. By the time we're done here, you'll see exactly how a drop of oil discovered miles beneath the earth actually ends up as a number on a company's balance sheet. It's a fascinating journey, so let's jump right in. But before we even get to the spreadsheets and the numbers, we have to ask a really basic but super important question. Imagine a company drills a well and hits a massive discovery. Who actually owns that oil? Is it the company? Someone else? The answer to this one question, believe it or not, is the key to understanding everything else that follows.
So here's how we're going to tackle this. First, we'll figure out who owns the oil. Then, we'll look at the rules for sharing it. After that, we'll follow the money from start to finish. We'll see how value is calculated and lost. And finally, we'll cover what these companies absolutely have to disclose to you and me.
Okay, let's dive into part one. Who owns the oil? Seriously, this is the bedrock. Forget accounting for a second. Before a single contract is even drafted, before a single dollar changes hands, this one fact dictates everything.
And it all traces back to one specific piece of legislation, the Petroleum Development Act, passed way back in 1974. You could say this is the cornerstone of the entire Malaysian oil and gas industry. It sets up the legal playing field for everything.
So that act gives us a very clear answer. The sole exclusive owner of every drop of petroleum in Malaysia is Petronas. That's right, not the international oil company that spent billions to find it, not even the government directly. It's the national oil company, Petroleum Nasional Berhad. They hold all the cards, which makes them the absolute center of this entire story.
Okay, so if Petronas owns all the oil, then how on earth does a company like Shell or ExxonMobil even operate there? Great question. And that brings us to part two, the rules of the game. And these rules are written down in a really, really important document called a production sharing contract.
For anyone working in oil and gas finance in Malaysia, the PSC is basically their Bible. It is the rule book. It spells out the entire relationship, and most importantly, it dictates two crucial things. First, how a company gets to recover the huge amounts of money it spends, and second, how the actual oil, the profit, gets divvied up with Petronas.
Now, these partnerships aren't all cookie-cutter. There are two main flavors. You've got your traditional PSC, where the oil company, the contractor, takes on pretty much all the risk. They spend the money, and if they come up empty, too bad. That's their loss. But then you have something called a risk service contract, or RSC. This is totally different. Here, the contractor is more like a hired gun. They get paid a fee for their work, but Petronas holds onto the oil and shoulders a lot more of the risk.
All right, on to Section 3. We've got the owner, we've got the rules. Now, let's actually follow the money. We're going to trace every dollar spent, from the very first geological survey all the way to the final sale of a barrel of oil. This is where the real nitty-gritty of the accounting begins.
This table really lays out the whole journey perfectly. Look at stage 1, before you even have a license. Any money you spend on studies, you just write it off as an expense right away. But then, stage 2, exploration, this is a game changer. The huge costs of seismic surveys and drilling, those get capitalized. They don't hit your profit and loss. They become an asset on your balance sheet, an E&E asset. Then, if you find something commercially viable, you move to stage 3, development, building platforms, laying pipelines. That also gets capitalized, this time as PPE. And then, once the oil is flowing in stage 4, the day-to-day costs are back to being expensed. See that flow? It's this incredible dance between immediate costs and building long-term value.
So this is the absolute key distinction you need to get. The difference between exploration and development costs. Think of exploration as the risky treasure hunt. You're spending a ton of money looking for gold. That cost becomes a temporary asset because, let's be real, you might find nothing and then you have to write the whole thing off. It's a huge gamble. But development, that's what you do after you found the treasure. You're just building the machinery to pull it out of the ground. The risk is way, way lower, so that cost becomes a proper, solid, long-term asset on your balance sheet.
Which brings us perfectly to our fourth section. So you've got this massive billion-dollar asset sitting on your books. Fantastic, but it's not going to last forever. Every barrel of oil you pump out makes it a little less valuable. So how do you account for that?
Well, the core idea is actually super intuitive. It's not like a building that you just depreciate over, say, 30 years on a straight line. No, an oil field's value is tied directly to the oil in the ground.
So it just makes sense, right? You should depreciate the asset based on how much of it you've physically used up.
And the tool for this is called the Unit of Production Method, or UOP. This formula is the absolute engine room of oil and gas accounting. It's what creates that perfect link between the physical world, barrels of oil coming out of the ground, and the financial world, the depreciation expense that shows up on the income statement.
Let's quickly break it down. It's actually pretty simple. You take the total cost of your asset and you multiply it by a fraction. The top of that fraction is how much you produced this year. The bottom is the total you think you can ever produce from that field. And that number on the bottom, the total reserves estimate, that is everything. It's not a hard fact. It's a highly educated guess by geologists and engineers, and it is the most critical and honestly the most subjective number in this whole process.
So, what happens when things go wrong, right? What if the global price of oil just tanks? Or what if you drill a new well and realize, oops, there's way less oil down here than we thought? All of a sudden, that big, shiny asset on your balance sheet isn't looking so valuable anymore.
Well, that's when you trigger something called an impairment test. Think of it as a mandatory reality check for your finances. Step 1, a red flag goes up, like falling prices. Step 2, you have to ask, is the value on my books higher than what I could actually get for this asset now? And if the answer is yes, then you hit step 3. You have to write it down. You take a loss and you adjust the value on your balance sheet to reflect the cold, hard truth.
Okay, so we've seen how all these complicated numbers are calculated behind closed doors. But how does anyone on the outside, investors, the public, know that any of it is legit? How can we trust it? Well, that leads us to our fifth and final section, what companies are forced to reveal. You see, companies can't just keep all this stuff secret. They're legally required to be transparent. They have to tell you how they account for things. They have to give you the details on any of those big impairment losses. And this is the big one. They have to disclose the reserve estimates. Remember that critical, subjective number? They have to share it. They even have to lay out the important terms of their contracts with Petronas.
And why does this matter so much? Because without this transparency, you'd be flying blind. These disclosures are what give investors and anyone interested the tools to actually dig in and assess the real health of a company. You can see their performance, you can understand the risks they're facing, and you can make a much smarter guess about their future. It's what keeps the whole system honest.
So, let's wrap this all up with the key takeaway. If you remember just 3 things, remember these. The whole system of oil and gas accounting in Malaysia is built on a story that starts with national ownership by Petronas. It's governed by the contractual rules of the PSCs, and it follows the money through a very specific life cycle of costs, from the moment of discovery right up until the last drop is pumped.
And this leaves us with one last question to think about. We've seen just how vital that total reserves estimate is for valuing a company today. But what about tomorrow? As the entire world starts shifting away from fossil fuels, what happens when companies start to realize they might have to leave some of that oil in the ground intentionally? How does that change the calculation? How will these shifting ideas about the future impact the massive, multi-billion-dollar balance sheets we see right now? Something to think about.